Hello, and welcome to the Baird Trust Equity Income Fourth Quarter Portfolio Recap. My name is John Watkins, and I'm a co-portfolio manager on the strategy. This first slide shows our performance track record. In the quarter, our portfolio increased 12.3% gross of fees and 12% net of all fees compared to the 9.5% increase in the Russell 1000 value and the 11.7% increase in the S&P 500. And for the full year 2023, our portfolio increased 9.1% gross and 7.8% net compared to the 11.5% increase in the Russell 1000 value and the 26.3% increase in the S&P 500. There are a few things to note on the one-year performance. First, the large gap between the S&P 500 and the Russell 1000 value is striking and was mainly driven by the strong performance of large technology companies, or the Magnificent Seven, which pay little to no dividends and are mostly excluded from the Russell 1000 value. Second, this divergence was actually the mirror image of what happened in 2022 when the S&P was down much more than the Russell 1000 value. Finally, the dividend factor created a substantial headwind for our strategy, even compared to the Russell 1000 value. For example, of the top 10 contributors to the Russell index for the year, 4 of them pay no dividend and only 2 have a dividend yield above 2%, and we own both of those. However, because we invest with a long-term business owner mentality, our primary focus for this portfolio is to generate an attractive total return over very long periods of time rather than quarters or single years. The next slide shows the individual companies that were our top and bottom contributors for the 1-year, 3-year, and 5-year time periods. The main thing I would point out here is that over the shorter 1-year period, there is a wide dispersion of individual stock price performance, with our largest percentage gainer in Parker Hannifin up 61%, and our largest percentage loser in Pfizer down 41%. As we often say, a company's stock price is much more volatile than its underlying intrinsic value. In the short term, stock prices can move around wildly. Our view is that short-term stock price movements don't tell us much about what's happening with the underlying business. For that, we look to things like revenue growth, margin expansion or contraction, earnings, and free cash flow changes. Moving on, this slide shows our recent portfolio changes. We made 3 changes throughout the year, 1 in April, 1 in May, and 1 in October. We exited 4 of our smaller holdings throughout the year: 3M, Kimberly-Clark, Verizon, and J.M. Smucker, and we reallocated these proceeds into 2 new holdings, Wells Fargo and Kenvue, as well as adding to several other companies that were already in the portfolio. However, when compared to the frenetic activity across much of the rest of the investment industry, our portfolio activity was relatively muted. Here, I would once again emphasize that we are long-term business owners and not stock traders. We are trying to identify wonderful businesses with competitive advantages that are run by talented CEOs. We aim to be patient and only purchase these businesses at a discount to our estimate of the company's intrinsic value. However, once we purchase a company that meets these criteria, we aim to own it for as long as possible, often multiple decades. One added benefit of this approach is that the low level of trading activity results in an extremely tax-efficient result for the client. On the left-hand side of this slide is the list of the 3 portfolio holdings that increased their dividend payments in Q4. While the fourth quarter is a relatively quiet one for regular dividend increases, I would point out that Fastenal paid a special dividend, Progressive announced one to be paid in January, and then Disney restarted their dividend program in the quarter as their cash flows are finally starting to recover from the massive disruption they faced during COVID. The table on the right shows the dividend characteristics of our equity income portfolio compared to our benchmark, the Russell 1000 value, as well as the S&P 500. As a reminder, 2 of our 3 portfolio objectives are to achieve a higher dividend yield and faster dividend growth than both of these indices. As you can see in this table, as of year end, we are achieving these objectives over the long term. Our view is that the combination of yield and growth together over many years can be extremely powerful. Finally, just a few big picture comments. We recently came across this quote from Morgan Housel and felt that it perfectly encapsulates not only 2023, but also much of the past 5 years. Entering the year, pessimism was rampant. The S&P 500 was coming off an 18% decline in 2022. The Federal Reserve was aggressively increasing interest rates to combat inflation, and it seemed almost certain the economy would tip into a recession during the year. Yet, to the surprise of many, the economy was resilient and the stock market was much stronger than expected. The experience of 2023, where most prognostications were incorrect, should serve as another small addition to the mountain of evidence that the future is nearly impossible to predict. In fact, much of the past 5 years underscores this point. So we are approaching 2024 with the same mindset we always have. We don't know what's in store for this year, but we know it will contain surprises. For this reason, we don't make predictions about the market or about the economy, and especially not about political elections. We don't believe predictions like these are the foundation of long-term investment success. Instead, we focus on owning a portfolio of great businesses with excellent leaders that pay attractive dividends and trade at reasonable prices. We have found that over time, that on average, this is the best way to prepare for whatever future surprises are in store. That does it for our annual portfolio recap. Thanks so much for your time.